just a minute, we're going to talk about the Boeing assignment that is due today, but I want to talk about a change in the logistics for next week. When I put together the syllabus for the class, I didn't put next week on the syllabus. I don't know how I missed next week, but I missed an entire week of the semester. So unfortunately, there's still work in a class next week. I just didn't put it on there. So I realized that this morning when I walked in, and I was like, oh, there's no class next week. But so here's what's going to happen. Basically, next week, I'm going to put in an additional group case, which I'm going to call group case 2.5. So technically, it's group case 4, but I'm not going to kill group case 3. So I'm just going to add a group case. Now, you can thank the 11 a.m. section for this, but I was originally going to make it an individual assignment. But when I told them what the individual assignment was and saw the horror on all of their faces and how 60% of the class was afraid of the assignment, I decided to make it a group assignment. Okay, so it's going to go back to a group assignment. And I'm not going to take points away from other assignments. So essentially, it's going to become the first extra credit of the semester. All right, so I was asked about extra credit. This is extra credit, but it's going to be done as a group project. So I'll be posting that group project later today. All right, it's going to be due Wednesday, 1 week from today, 10 a.m. for all sections. Same groups that you're working on now. Okay, so a word about grades before I talk to you about the assignment, because it's going to confuse you going forward the rest of the semester because of the challenge with ELMS. So in this class, grading is based on 100 total points, okay? So essentially, right now there's 100 total points. After I put up this first extra credit assignment, group case 2.5, there's probably going to be 102 or 103 total points. I haven't decided how many points, 2 or 3 points for the extra credit. So as of next week, there's going to be 103 potential points available this semester. Now, the way ELMS works, and I can't change this, is that let's say you get 90 total points as your final grade. What ELMS will do is it will say your grade is 90 divided by 103, and it will put you into the B+ range, right? But that's not your grade, because in this class, absolute points equals a grade. So if you have 90 out of 103, that's actually an A-, because 90 points is an A-. So your grade going forward on ELMS will look worse than it actually is, because ELMS does it as a percentage of total points available. They don't do it based on an absolute scale. So with the first extra credit, there's going to be 102 or 103 potential points this semester. Again, 97 or more is an A+, 93 is an A, 90 is an A-, 87 is a B+. I'm not changing that, but what I am going to change is the total point population available. So essentially, it's like getting a free assignment. So let's say you lost a few points on something before. This is your chance to make it up, okay? So it doesn't hurt you. It can only help you to do this extra credit assignment. And you're going to do this as a group, not individuals. Questions about that? Hopefully, I'm sure you will, but at least conceptually, I wanted to get it out there. Because you're going to go back later, you're going to be like, what's my grade? Oh, I'm disappointed. And it's like, no, ELMS is going to confuse you, right? So going forward, here's what the assignment, we'll talk more about this at the end of the class, is going to be. So when you turned in your Boeing model today, I don't know if anybody noticed, but it doesn't balance. It has an unbalanced TFI and has an unbalanced CFI. So part of the assignment for Wednesday, fix the model. Because you have turned in, as far as I'm concerned, an invalid model because the model doesn't balance. Now, I'm not going to hold it against you for this assignment. Okay, so this assignment is going to be graded assuming that you turned in an unbalanced model. And technically, it doesn't affect your valuation because the future cash flows have nothing to do with the historical numbers that are unbalanced because the future balances, and they're based on actual cash flows. But that being said, going forward, you're not allowed to turn in an unbalanced model in this class. So therefore, you have to balance the TFI and the CFI. Okay, so when I told the 11 a.m. section they had to do this individually, that's when everybody freaked out. Because basically it's a real world problem. Because, and as a matter of fact, I wasn't expecting this. I had no idea Boeing was going to be this problem. But it's actually cool that it is this problem because this is what you deal with in the real world. Like you deal with real companies that have missing information. You got to figure out what's missing to make sure that everything is in your model. So if you remember 2 weeks ago, when I told you to do this assignment, for model data, these are the data points that we're now exporting. Okay? Except I'll use a metaphor. When we rearrange the statements, we're missing a Lego. So there's an item that Boeing has reported that Bloomberg put into its standardized statements. Because what I tried to do is if you go to FA, these are the historical statements, and you go to the balance sheet, these are the standardized historical statements. And what I tried to do is I tried to figure out which Bloomberg fields were in the standardized statements. That is what was on that model export tab that you created, that you did this assignment on. But I told you, every now and then, even though this is standardized, a company will get an item on it that Bloomberg will put in that wasn't there before. And unfortunately, they don't always put it in for every company. So even though it says, quote unquote, standardized, what I found over time is it's not as standardized as you think it is. Because you would assume standardized means standardized. And so it's really just standardized for that company. Yes?
So you're saying Boeing's missing something?
There is something that Boeing reported that is not part of the standardized statements that we created.
So we're missing something.
We are missing something. Bloomberg added to the standardized statement an item Boeing had that we don't have. But here's the thing. They didn't add it for every company. They only added it for Boeing. So even though it's a standardized statement, it might have been added for other companies for all we know, but it wasn't in Parker Hannifin. So for example, they didn't have it, so it wasn't there. So part of your assignment is to figure out the missing piece. And by the way, I'll tell you in the last class, somebody got it within 10 minutes, right? He's a very popular guy, right? He's not supposed to tell. He's not. I said, look, bribery's not allowed in this class. So he can't tell you because his group has already solved the problem. So I know it's a very solvable problem, and I can give you the hint that it's one item, okay? Because I didn't even know it either. Because I just saw it on Monday, and I was like, oh, we'll figure it out on Wednesday. And I thought, oh, instead of me figuring it out, it'd be better if we all figure it out together because I had to figure it out too. So I'm just saying it's one item that's missing. So here's what you're going to have to do. You're going to have to figure out what that missing item is. Now, again, by the nature of the statements, we know it's coming from the balance sheet because TFI doesn't balance and TII balances. So it's a balance sheet item, and that's why the CFI is being thrown off. So we got to figure out which item on the balance sheet that Boeing is reporting on a standardized statement that we don't have. Okay. Now, what's going to have to happen is when you go to custom and you go to your model, whatever you called it, that the file that you exported repeatedly, if this happens to come up with another company, then we want to make sure that we don't have this problem again. So what we're going to do is the very last item, we're just going to add whatever it is as the last item. So that way it's always exported. And then here's the thing. We're going to have to, when we import it into our Excel model, you're going to have to basically, you'll then get it as the last item down here. So it'll now be on row 81 instead of row 80 being our last item. You'll have to then hook it up to the balance sheet and hook it up to the TFI. And that should actually get the CFI to pick it up. But if not, then hook it up to the CFI. But that's the point. Once you add it in, everything will balance, and then you have a valid model. And if another company has whatever this item is, it will then always pick it up. But I can't tell you this isn't going to happen again. And this is what I was referring to, is that unfortunately, in the real world, we can't anticipate that some company may not have something that others don't. And if Bloomberg adds it, we got to figure out a way to put it in our model. So again, real world problem that I'm going to ask you to solve. And based on what happened last class, it's relatively quickly solvable. All right, he solved it very quickly. Yes?
So is this just looking at our model versus what Bloomberg had?
Yep. And I'm just telling you, because it's TFI, I can narrow it further down and tell you it's on the balance sheet. That there's something on Boeing's balance sheet, a standardized balance sheet, that we don't have in our model. And we got to add it. Okay? But because it's standardized, well, let's add it for every other company. And I'll give you another hint. Parker Hannifin didn't have it. So it's not part of our model today. So we got to add it. We got to add the field. And it's one field. And once we add it, everything will balance. So that's the first part of group case 2.5. Due next Wednesday. So take the file you submitted today, fix it. Then, and we'll talk about this more towards the end of class, you have 4 total Excel files that you're going to have to submit. That's the first of four, is a fixed as-is model. Right? Second, third, and fourth is a 12-month target stock price Excel model, a bull target model, and a bear. So going forward, we will always start submitting 4 files: target, bull, bear, as is. Okay, we've only done the as is. So here's the thing: fix the as is first, because when you use it to create the bull, the bear, and the target, you don't want to have the flaw in that model as well. Okay, so you make sure that you fixed it before you create the other 3 Excel files. And then you're going to turn a Word document as a team explaining, probably 500 word minimum, explaining the changes in assumptions across those models. Okay, and that's really, again, I'll talk more about in detail today what the assignment is, but that's the assignment that's coming up for next week. Okay, questions about that? Okay, so let's talk about group case 2, Boeing today. So the first one for Boeing is EIC. So this was a screenshot of Boeing's beta as you answered the EIC, right? Did it based on global competitors for the whole firm using the BIC's best fit algorithm. So industry beta of 0.89 raw, 0.93 adjusted, Boeing 1.01, 1.01. So what would you say about the E? What was your answer for the E in your write-up based on this data? What should we say about the Boeing's E in the EIC? Did anybody write it up? What's in your write-up? Should I just pull up one of the write-ups and read it? That'd be simple. Like, what'd you guys say? What'd you guys say about the E? What's 1.01 tell you? Yeah. Yeah, Boeing's a little bit more sensitive than the industry, but Boeing is still going to kind of be going up and down with the market. So market changes are going to affect Boeing, right? And again, we can think about this with the 1.01. It means it's basically going up and down with the market. So think about this kind of intuitively. You know, Boeing is selling planes, and planes are going to be based on airlines buying them, which is going to be based on travel. And in bad economic times, people don't travel as much. Airlines don't buy as many planes. In good economic times, people travel more. Airlines buy more planes. And so that's the point. That's probably why their beta is very close to 1, and even the industry is at 0.9. So for them, figuring out what's going to happen with the economy is probably important. And as I mentioned in the last class, hey, read the headlines. In the last couple weeks, markets have been more turbulent because interest rates have been spiking and people are starting to use the R word. Right? Recession is actually starting to be talked about, popular press, as a potential. Not saying it's going to happen, but people are starting to put it out. And that's the point. That's going to be bad for Boeing and to some degree their industry, because if people think there's a recession, then basically they're going to cancel orders or push orders into the future. So Boeing is somewhat more sensitive than other companies to the market. That's what we see. That's our E. Right? Next, industry, and then to some degree C, competitive advantage. That's where you need to do the RV screen. So in the RV screen, we would have gotten an operating ROIC for the industry of 15.8% and a WACC of 8.78. So this is an attractive industry. Now, here's the thing. I put the ROIC column in for reference. I told you we're not using ROIC anymore. So if you did ROIC and you didn't do operating ROIC, you get no credit for this section. Okay? So you had to use operating ROIC. Okay? So again, 15.83. Now here's what's interesting. Boeing is a double dash, which means Bloomberg is not calculating the ROIC properly for Boeing in 2017. So here's the deal. You can't use 58.56 in your answer because it's an apple and an orange. This and this are not comparable. Okay, so you can't use 58.56. So you actually have to use Boeing's operating ROIC to answer the question. So what is Boeing's operating ROIC in 2017? And where do we get it if Bloomberg isn't calculating it on the screen? Where'd you get it for your paper and for your answer? The operating ROIC for Boeing. What'd you put in? Because you had to get one. Otherwise, you couldn't answer the question. So if you're like the previous class, where I think you'd have gotten it, or should have gotten it, is in your Excel file. The second part of the assignment was the ROIC tree, and right here in the ROIC tree is the 2017 operating ROIC. That's the number, 93%. So if you'd used 58, you'd have been directionally correct, but you're not going to get credit for being directionally correct in this class because you based it on the wrong number. So basically, just to be really clear, when you complain to the TAs about grading, writing words down in a paper does not entitle you to any credit in this class. Okay, so your grade is not based on how many words you write. It's based on whether you're right with the words that you do write. Okay, so if you say a lot of words but you're wrong, you don't get partial credit. Okay, so that's the point. The operating ROIC is the number you had to explain. So if you explained it with the wrong ROIC, you're still not going to get credit, even if you were directionally correct. So back to this, 93%. So that was the number you should have put in your paper, and it should have been obvious to you to put that in the paper because that was actually part of the assignment you had to do. Again, this is why I like the real world, because you run into these real world challenges, you got to figure things out. And so I wasn't expecting that Boeing would involve a couple of exceptions, but it did. And I actually find this to be kind of cool because it helps you figure out how to solve real world problems. So this was a real world, very solvable problem. You just had to go look to the second part of the assignment. So again, attractive industry. Now, 5 forces. What explains the attractiveness of this industry? Why is this industry so attractive? Why is it making 15% or whatever it was against an 8% cost of capital? 16% against a 9% WACC. What'd you say about the 5 forces? Which of the forces helped? Buyer power? What'd you say about buyer power? Who has the power in the relationship? Boeing and Airbus, or the airlines? Yeah, they're a duopoly. I mean, basically, if you want big planes, you don't really have many places where to go. A lot of power is with the companies, not with the buyers. The buyers have very little power. It's one reason why this is a very profitable industry. All right, substitutes. Really hard to build substitutes to go international travel across oceans. Okay, so practically, there's not a lot of viable substitutes to the airline industry right now. That could change over time with video conferencing for business meetings, but for leisure travel, you want to go to Spain, I don't know how you're going to get there. All right, you're going to fly. Right? So practically, substitutes are not that strong right now for the industry. Barriers to entry are pretty high. It's really hard to build planes to the level of spec that are needed to satisfy the regulators for safety at the level that Boeing and Airbus do. So again, there's a lot of barriers to entry to get in this business. And if you think about it, the rivalry is not that intense because they're a duopoly. I mean, they fight, but they don't fight to the death. It's kind of like Coke and Pepsi. Last thing I want to do is lose a lot of money because I don't have to, right? And they have lots of back orders and not a lot of choice. So again, there's not a lot of supply relative to demand, and there's a ton of demand in the industry, particularly outside the U.S., China in particular, low-cost airlines in Asia, and also in Europe are buying a lot of new planes, and that's really just good for the industry. So again, some combination explains why this is an attractive industry, and to be honest with you, I don't think much is going to change in the next 5 years. So I still think they're going to probably have it. Longer than 5 years, I could see some changes. So for example, China's talked about having their own kind of global carrier that builds planes. I think eventually that's going to show up, maybe not in the next 5 years, but that's a viable threat. The other thing is you got companies like, was it Bombardier or who's the other one that makes basically smaller planes that are now starting to make bigger planes. And so they now are building 100-seat jets, one of those two companies. And so the point is the smaller makers are actually starting to build more competitive planes to a 737 or an Airbus A320. So that could be in the next few years more of a competitive threat, but right now it's really a duopoly. Okay, so I think that explains the industry, and I think Boeing's going to do well for a while. All right, so that's EIC. Questions about EIC? Okay, second part of the assignment was walking through the tree. So you started walking through the tree. Again, for this assignment, beginning and end is what's necessary, but I'd like you to start talking about the middle. So you're not required to talk about the middle, but it'd be great if you start talking about the middle because you're going to have to soon. So between 2013 and 2017, ROIC went from 65.8 to 93. So big jump in ROIC. Although if you actually look at the trends, almost all that jump occurred between 16 and 17 because it went from 63.8 to 41 and then up to 93. Okay, so really something happened between 16 and 17 to really help Boeing. If you look at tax rate went from 26.4 to 18.4. So tax rate definitely helped Boeing between the 5-year period. But the pre-tax also went up dramatically from 89.4 to 114. But again, almost all the pre-tax improvement, because it was kind of trending downward through 2016, occurred between 16 and 17. Okay, so here's the thing. If this were your group project that you're presenting to me in about, 45, 50 days through the end of the semester, I would stop your group in mid-sentence and I would say, what happened? What happened between 16 and 17 that caused this dramatic change? And I would expect you to know that answer. Now, that's not the case for this simple assignment, but over time, that's what I mean. You got to know what's going on that's changing these numbers, right? So keep going. Why did the pre-tax ROIC go up? Well, if we look at our operating margin, it went from 7.6 to 11. So a lot of it was the operating margin, 7.6 to 11 between 13 and 17. All right, and again, almost all the improvement in operating margin happened between 16 and 17. Invested capital to sales actually worsened. It went from 8.5 to 9.7, although it actually got much worse and then started trending down between 14 and 17, but nonetheless, a little bit worsening productivity. So if we think about pre-tax ROIC, it was all margin. Okay, and almost all the gains came between 16 and 17 in the margin, going from 6.2 to 11. All right, second level of analysis, what drove that operating margin? Gross margin, 17.5 to 20.8. And again, most of it in 2016 to 17 when it went from 16.6 to 20.8. All right, SG&As went down from 7.8 to 7.5, and depreciation went from 2.1 to 2.2, virtually unchanged. So really, it was about gross margins. So it was a big jump in gross margins, particularly between 16 and 17, that drove the operating margin from 6.2 to 11, and that was really the primary reason why the pre-tax ROIC went up from 89.4 to 114 between 13 and 17. If we look at the balance sheet, why did the productivity worsen? Well, operating working capital started out at negative 12.7, ended at negative 12.6. So working capital was virtually unchanged. However, in the intervening years, working capital worsened. They went from negative 12.7 to negative 5, and then it started getting better between 16 and 17. Okay, so obviously they had some challenges with working capital in 2014, 15, and 16. Right, but then they got it more normalized in 17 and landed where they started. PP&E to sales went in 2013 from 11.8 to 13.6 in 2017. And again, it looks like the big jump occurred between basically 14 and 16. They went from 12.1 to 12.6 to 13.5, and then 13.6 between 16 and 17. So it looks like about 2 years ago is when they started ramping up PP&E. Intangible to sales went from 9.3 to 8.7, so that really should have helped them, so that didn't explain the increase. So the worsening of invested capital sales was all PP&E. Matter of fact, it's interesting that, again, here's how I can start surmising some of the challenges they're having. Investigate to clarify, but it looks like they had some trouble with inventory between 13 and 14 and 15, right? So it's production problems, right? This is when they were, if I go back in memory, having trouble launching the 787 and to some degree the 737 MAX. So they're having some challenges. And then they kind of built the capacity as they were ramping up in 15, 16, and 17. They're now in production, heavy production mode. Costs go down. They're also selling much higher profit jets, and they're actually starting to do much better. All right. I'm guessing that's what happened, but that's the point. We now have enough information we can go investigate. That's beyond what I'm asking you to do for the case, but nonetheless, I think that's what we see is going on with Boeing. All right, questions about the tree? Okay. All right, third part of your assignment was the as-is valuation. So again, you'd have gone to Bloomberg. From the FA screen, you'd have export to Excel this file. I'd put up in the file section a series of solution files for you. but you basically would have created this exported file. You'd have gotten rid of the dashes and replaced them with zeros. I think there were like 38 of them or something. And then you'd have selected this file, copied it, gone to our model, taken the Parker model, right-click the same tab, paste special, values, and basically updated it with the Boeing data. Okay. Then you would have gone to the Assumptions tab, and the first thing you'd have changed is the last reported year was 2017, Parker was 2018, because Boeing has a normal December 31st year, so we'd have changed it from 2018 to 2017. Right? We'd have gone to the WACC screen, 9.7%. So again, I did mine on Monday about 11:30 in the morning, so 9.7% was the WACC. All right. I don't know if your WACC is exactly 9.7, could be 9.6, maybe 9.8. And the reason I say that is because one of the components of WACC is equity. Equity is driven by CAPM. CAPM is driven by risk-free. And if you haven't paid attention to your stock game simulation challenges, basically, you can see it here, 10-year Treasury where is it? 10-year. Right now, the current 10-year yield is 322 basis points. All right. And if you've been paying attention, interest rates, particularly in the last 30 days, have gone up by 23 basis points. And since the beginning of the year have gone up closer to 50 basis points. So 10-year treasuries have been rocketing. And as a result, last few weeks, stock market's going down. Higher discount rates, lower values. It's just math 101. But that's the choppiness we're experiencing in the marketplace, is the rise in the risk-free rate. So that's what I mean by literally with the rates spiking as quickly as they are, your WACC may bounce around a little bit day by day. All right, because treasuries are much more volatile. You got people like Jamie Dimon of Chase saying that he thinks it's going to hit 5%. Right? That can be really bad in the short term for the stock market if it does hit 5%. But nonetheless, that was the WACC. Next, you've gotten your DES, because that would have gotten your stock price. I did again mine Monday 11:30, so my stock price was about $380 a share, $379.99, and my share count 574.5 million. So put in my current share price, very important for grading, because obviously if I'd done it over the weekend, stock price had already gone down $5 or $6 a share by 11:30 Monday morning. So I would have had 385 versus 380. My assumptions would change. Matter of fact, if I did it today, Boeing is down to, looks like they were down even more today. They're down to 370 a share. So they're down $20 pretty quickly in the last week. All right, so that's what I mean by the day by day, or sorry, $15 last week, but day by day matters. Okay, but nonetheless, that was my current share price. That was the share count. And then the final piece was the EEO. And one of the things you'll see about Boeing is that the number of analysts that are forecasting out year 3 and 4, much higher than Parker Hannifin, right? If no other reason, Boeing has a gigantic backlog. So they are a much more predictable company because of their backlog than most other companies. So I think analysts are more willing to publicly put their names on a longer term forecast. So I'm definitely going to use at least the 3 years. I might even use the 4th year when I do my as-is model, because I think it's actually much more forecastable than a company like a Parker Hannifin by the analysts. Okay, but nonetheless, put in the middle minimum 3 for revenue and EBITDA. Okay, when I've gotten these EBITDA margin based on the estimates, then I go over to ratios. Okay, if I look up the tax rate, go to EVT, look at the earnings calls, 16% is the number they guided the analyst to. So you should have basically put in a 16% tax rate because that's what Boeing told the analyst to use. So essentially 16%. Okay. And again, if you look at the historical years, they were as low as 12 already and 18 last year, and that's when taxes were 35. So I think Boeing is somebody who does international sales, and so it's not unreasonable for them to basically get a lower tax rate. So 16% does not seem out of bounds, right? Next, we do all this, and we try to get the stock price. We're very far off from the stock price because we got the growth rates, which I left trending out about 7% a year, and this level of margin, which is some of the highest they've ever had, and I'm still way far from, I'll show you, the current stock price. 274, need to get to 380. So the last one is G. Now next Wednesday, as part of our next class, we're going to talk about how we can back into a G based on observable market data. I'm going to give you a process for estimating a G. But right now we don't have that, so you can still take your swags. But the point is I need a higher G. And it conceptually makes sense, right? So again, somewhere in the 5% range, I did 5.15, and that basically got me within $1 of the current share price, as is done. Right? So it wasn't that difficult of an exercise, but nonetheless, you might have slightly different numbers. As long as you can justify that with your assumptions and your write-up, that's what matters, right? Because I can't say I'm exactly right on this. Might be a little bit higher growth, a little bit different margin, a little bit different G, but basically, that's what you want to do. Now, I know in the last couple classes, people talked about lowering their WACC. Anybody lower their WACC in this class? All right, why did you lower your WACC? What was your rationale?
We looked at what they were saying online about I forget exactly. I didn't do the write-up for that.
Okay. Why did you guys lower the WACC? Well, what WACC number did your team use? Do you remember?
We used 8.63.
Okay. What'd you use?
Rationale part of it was we didn't want to change the growth rate because we thought like beyond 3 was too aggressive. And then like changing the WACC was too aggressive, but we kind of like.
All right. So here's the thing. I can't say that you're wrong, even if I disagree with you. We're not going to ding you as long as you're reasonable. However, I don't think 8.6 is reasonable. Right? And I'll give you two rationales as to why. Right? Rationale number one. Think about CAPM. What's happening with CAPM? Risk-free rates are going up dramatically. So it's hard to argue that WACCs are going to go down by 100 basis points if you're seeing such spikes in the 10-year treasury. Because that means that the risk-free is going up, that the risk premium has to go down even more dramatically, or you're arguing that Boeing's beta is high, right? And it goes back to planes. So what you're saying is when I wrote my EIC, if I actually said that Boeing's pretty sensitive to the economy, what you'd really have to say is Boeing's not sensitive to the economy. And if we go to higher interest rate in troubled times, it's not going to affect Boeing. Well, that's not what their beta says, right? Now, maybe the beta is wrong, and that's your case for arguing it. But so here's the point. What you'd really have to do is say the industry beta was closer to 0.9. If I went into Bloomberg, WACC, and I changed my beta to 0.9, that would actually give me a 9.1% WACC. So really, if I then, and somebody said in the last class, they changed the risk premium because they didn't agree with Bloomberg's risk premium, and I put in a 5.5% risk premium, McKinsey's argument for risk premium, then I'm closer to 8%. But that's what you would have to agree. You have to basically say, right now, the market's got it wrong. The risk premium's too high. And simultaneously, you'd have to say the market's got it wrong. Boeing's beta is too high. Now, I know this is subtle, and I know that nobody did what I just said to do, but this is what I'm saying, like, this is what we're going to practice getting good at, because if you have assumptions, now I may not agree with those two statements, but if you had written those two statements, I can't say that you're wrong. I can just say I disagree with you, and I can give you credit, because at least you're being logical, and it's fact-based to get to that beta. Right? So that's going to be the nuance that's going to be much more important going forward, and we just have to practice. Now, you might say, well, gee, I didn't do this yet. That's okay. We're going to have lots of assignments over the next few weeks, but this is what I mean by this makes you a better analyst. And just to mix metaphors, at the beginning of last class, somebody came up to me and they said, look, Professor Perfetti, I'm getting ready to do an interview tomorrow that's going to be a case-based interview that's going to be technical. How should I answer the questions? Any advice? And to be honest with you, the answer I gave him is no different than the answer I'm giving you here today. Like if you're given a case-based interview and the company's like, okay, how does this company raise its margins? what a lot of people will do is they'll say, okay, raise margins, improve gross margin, lower SG&A, and that raises your margin. And that person, I can't wait to get them out of the interview room. I will never hire them, right? Because every financial candidate that walks in knows to say that. I can put in a quick income statement that says, increase this, lower that, and you get better margins. That's useless information, okay? What's more information is why. Why is the gross margin going to go up? What about the company, the industry that's going to fundamentally change? That's the assumption behind the change in gross margin that will differentiate you from most candidates, and that's what I'm looking for. All right, I want the process side as much as the absolute answer. And I want you to show me your assumptions and make them defensible, and that's the point. That's what a good analyst is really about. So back to this class, that's why you're doing the write-ups, that your assumptions also have to be consistent. Because if in the EIC section, you said beta of 1, and you didn't say it shouldn't be 1, it should be much lower, but then in your valuation, you said, no, the beta is much lower, and the company's not as sensitive to the market, and therefore should have a lower MAC. That's a completely inconsistent submission, because your EIC should be consistent. So if you made that argument, it should be in your EIC. Now, I don't think the TAs are going to grade you that harshly on this one, but when I grade your final presentations, this is what I mean. Like, you can't just do independent silo valuations because they kind of build on each other, right? And they can't be inconsistent across this. And you got to have rationale. So that's what we got to practice. So I'm more likely to want to leave the WACC alone, but for this assignment, if you give a rationale for why it should be lower, can't say you're wrong, and you'll probably get credit for this assignment. But in futures, just make sure that you've really thought through before you just throw out a number, because it's easy to plug and chug. I'm not saying we have to do some plugging and chugging, but the rationale for the plugging and chugging is really what we're going to start grading you on, because none of us can truly predict the future. All right, that was the assignment. Questions? All right, next piece, G. As I said, next week, I raised the G to 5. Why did I do 5? That's also a good question. So I'm going to try and draw this, all right? And I don't know if I can or not, so I'm going to try and do it on my computer. So it's going to come out probably very poorly. Try PowerPoint. Blank presentation. Slides, layout, blank. Drawing. This is when I wish I actually had like a pen or a pencil that I could draw on my screen. All right. I'm looking for it. Oh, there's draw. Thank you. Maybe I can do it here. Oh, even better. Thank you, Microsoft. Cool. So I got a pen. And I don't want it to be too thick, so that's probably fine. Okay, so, oh, all right. Thank you for that tip. Okay, here we go. Axis. This axis is time. Didn't say I'm very good at drawing with a mouse. And this axis is cash flow. And if you think about a company, it's kind of like a product life cycle. Over time, a company is probably going to look kind of like a product life cycle. And if we assume that it's an enduring company, it'll have mature, won't go away. But that's not necessarily the case because, for example, Sears this morning announced they're about to file bankruptcy. So I think Sears is actually going to go away. I don't think they have much longer on this earth. But regardless, you know, half, that was a good data point, half the Fortune 500 is gone since the year 2000. Just think about that, right? So we've lost half of our big companies in the last 20 years, right? So I actually don't think this is actually probably aggressive. But let's say we have some enduring companies. So here's the point. How do we do our valuation? Think about our valuation tab, and this relates to G. We have two periods. We have 5 years, and then we have year 6 into infinity and beyond. So let's say that years 1 through 5 get us right here on the company's life cycle, and this is 6 to infinity. That's the perpetuity. That's the continuing value period. So here's the point. If this represents this stage of the company, and I say 2 to 3%, this is 2 to 3% as a trend line. And what it's going to do is I'm going to undervalue the company because I'm going to miss all of this growth before the company gets mature. Right? That's Boeing. Right? That's Google. Google is growing at high double digits or high teens right now, right? 15 to 20% a year, right? Boeing is growing at 7 to 10% a year for the foreseeable future. So saying that they're going to grow 2 to 3% in infinity is probably underrepresenting their long term. Now, Google's not going to grow 15% forever. They're eventually going to mature and decline. So what I do is I need a G somewhere between the two. So instead of 2 to 3, maybe the answer is 4 to 5. As opposed to 8 to 9, because I need to capture this and the eventual decline. Or year 1 to 5 is here, and you're dealing with a company like Procter & Gamble or Unilever that are mature. They're growing Clorox 1 to 2%. They're just growing with the U.S. and European economies. They don't have a lot of growth right now. They're very mature businesses. So that's the point. 2 to 3% is probably what I need because they're already growing 2 to 3%. So my perpetuity G probably doesn't need to change too much. Versus I'm here and my company's in decline. I'm at GE. GE is falling apart. They're the company of yesterday. They're not the company of tomorrow. So putting a 2 to 3% G is actually probably unrealistic because as GE continues to have challenges, their G might actually be negative because the future is a decline. The future is not great, and they're going to get worse from this point on, not better from this point on. All right, same thing with Sears. Sears is probably going to 0. So I need a big negative G if I'm doing Sears to value them as opposed to a positive, and that's the point. This is what I meant when I said 1 to 5 years was arbitrary, right? And in an idealized world, we forecast enough periods to get to here. That's when we really want to have the G, but that's not going to be practical. So that's the point. Some of the companies are going to be here. Some of our companies might be here. I'm doing Square, right? Square has a lot of growth ahead of it. It could be doubling in size every year. So let's flip that around. How do I value that? It's going to be all in perpetuity. Very little cash flow in the next few years. So that's why when I talk about next week, we're going to have a little bit more of a conversation about G, right? How do we actually get a more realistic G? But if you want to know why I put 5%, that's why I put 5%. Because my argument was I really don't want to lower the WACC. Right? I'm explaining my assumption for this because I'm seeing what's happened with the risk-free rate. And I see that in the EIC, we said Boeing industry beta, not 0.9 something, and Boeing at 1. I don't think that that's going to dramatically be different going forward. So it's hard for me to justify a lower WACC. And don't get me wrong, Parker Hannifin, something weird's going on there. I'm going to go talk to that company. I'm going to ask them if they're willing to guest lecture and help us understand what we're missing. Because I like these exceptions. The exceptions help me understand the rule. Right? But I don't think Boeing's an exception. Not from what we're saying. Right? So that's why, to me, it's raising the G. Because changing the tax rate, that doesn't really make too much sense. Changing the margins to be even higher, well, that's not going to close the gap, but I think that that's already unrealistic. And then changing the growth rate to be that much higher, 20, 30% a year in the next years, 3 through 5, that seems a little unrealistic. So by process of elimination, G is my only option left, right? But this is my rationale for why I changed the G. Okay. And by the way, this is what I'd be writing up in my paper, right? Because I want you to understand when you see my assumption, why I made the assumption that I did. All right, questions about any of that? Okay, great. Okay, so back to our assignment for next week. So our assignment for next week, part 1, fix the model. Fix the as is. Get your TFI to balance, which will get your CFI to balance, which will get your model to balance historically. And right now, this is how much it's off. All right, your hint, thanks to somebody in the last section, it's one item. They already figured it out. Okay, so again, you're looking for one item that's missing from our standardized balance sheet that we got to add from the Bloomberg model and flow through, which means you got to link it across the tabs so we have it as a reusable solution. Once we do this, we create spreadsheet number 2. So save this as your as is, file, save as is, and then file, save as, target. Okay, so spreadsheet number 2 is called the target. So what's the target? Go to Bloomberg. Boeing, ANR. These are the analysts, and these are their 12-month price targets. That's what you're creating, a 12-month price target for Boeing. Okay? And by the way, there's not unanimity here. Some people think it could be 350. Some people think 437. Okay? So there's not unanimity about what the target could be. All right? But this is your chance, unlike the as is, to put in your opinion. So the difference between the as is and the target is your opinion. All right? What do I think the stock price is going to be, as opposed to the as is, what is it now? That's the distinction between the two. And as I said, in the real world, there are 20 analysts who think it's going to go up, 8 stay about the same, 1 go down. There's not a unanimous on what's going to happen to Boeing. It's real world, right? But, so here's the point. If you average all these target stock prices today, you get 413.43. And today they're trading right now at 371, which means the market is saying 11% upside in Boeing. That's the difference between the targets and today. So here's the deal. Plus or minus 10% is called a hold. More than 10% is a buy. Less than 10% is a sell. Okay? So if I really believe the market, it's a buy. Right? If the market is right, Boeing's a buy because it's going to go up 11% next year, and the threshold to get to buy is typically 10. And that's the buy, sell, hold opinions. That's exactly how they create the buy, sell, the hold. Because the idea is plus or minus 10% is a trading range. So I'm not going to buy a stock because it's going to go up 8% because that's just too much trading range risk. I'd rather just take the S&P 500 index at that point. All right, that's why they'll call it market weight. Because what they're really saying in market weight is just weight it with the market because it's going to kind of go up with the market. It's a hold. Right? Overweight doesn't mean you're fat. Right? Overweight means literally have more Boeing than the S&P 500 in your portfolio because it's going to go up. That's why they say it's a buy. Buy more Boeing relative to the market. So they'll use different terms. Buy, overweight, outperform. But what they're really saying is, I think you can make more than 10% buying Boeing. So buy Boeing. And the market's probably not going to go more than 10% a year over a long period of time. Sell, I think Boeing's going to go down by more than 10%. Morningstar, 323. Sell. Sell Boeing. Right? Because it's going to too much downside risk. Get out. Okay. So again, target your chance to put in your opinion. How do you put in your opinion? So I come in here and I basically say, okay, so here's my thoughts. Thought number 1, I think 5% growing long term is too high. I think it's going to be closer to 3%, and here's why. It's not that Boeing isn't going to do well and have upside. I worry that there's a trade war, which means some of these countries that Boeing's selling a lot of jets are going to cut back their orders, particularly Asia and China. Right? Number 2, I worry that there is more competition because companies like Embraer and Bombardier or whoever that makes the mid-sized jets are basically going to start building bigger and bigger jets, and that's going to be bad. And number 3, if we start heading towards recessionary times, Boeing's a 1, and we're at the peak of a cyclical business, and the peak is just too high. So therefore, I don't think that the future is as representative as what the market says right now. So therefore, I think it's more likely that they're going to probably go closer to 3%. Right? Given that, I do think in the next few years, the growth rates will be a little bit more tepid because of the reasons I just said. So I'm going to put it at 5% because they do have a backlog. It's not going to go away. Right? And I don't think the margins are going to be as strong. So I think they're going to trend down closer to 14% with the backlog. But here's the point. 242. So, right? That's probably too aggressive for 12 months for all that to happen. So maybe I'll do a 4% G and I'm at 280. But the point is, this is my opinion. And I put in some numbers that should be somewhat realistic that basically say what I think the sell should be. Okay? This is probably being a little harsh on Boeing. So maybe 4.5%. And so I'm closer to 6 and 14.5. And I'm going to just temper this only because they do have a backlog. They have years of planes already on order. Now, as either the airlines cut, they're not going to cut all of those orders. So again, I can still put them in the sell range because this gets me a share price closer to 320, which is Morningstar, by the way. All right, so that's my sell. By the way, an exact same analysis could do the buy, which means somebody else could have a much more optimistic scenario that says, no, it's going to be 8% growth. The margins are actually going to stay as strong, if not get stronger. And oh, by the way, I actually think that the long-term growth rate is about right. So Boeing is really worth closer to $400 a share, or let's do 5.5 just to make the number bigger, $423 a share, so therefore buy. Okay, and here's the reason why I think it's a rosy scenario. By the way, both of those people could get credit in this assignment, right? Because I can't tell you either one are right or wrong as long as you give reasonable assumptions that tie this back together. Does that make sense? That's your target. Okay, so the piece of the target is take those 5 main assumptions, change the 5 main assumptions to get to a target stock price. Now you can put in your opinion. Okay, so, Excel file number 2. Excel files number 3 and 4 are what are called the bull and the bear. Okay, so here's what matters. And again, I'm going to go back to my cool drawing tools in PowerPoint. So let's create another slide. And let's go back to this drawing tool tip you gave me. So here's the point. This is time, and this is price. I don't know what Boeing stock price looks like, but let's just say it's, well, probably is not going to do that. But we get to today. This is today. You can laugh. I know it's funny. I can't draw straight lines. That's why I'm a finance person. I'm not like an arts and crafts person. So I couldn't do drawing. And penmanship is not my strong suit. All right, so here's the point. Here's their stock price today. So if I'm a sell, then what I say is this is whatever it was, 380, time of my valuation. And I think it's going to go down as low as this is 320. I'm in the sell range. That's my 12-month from today target stock price. So here's the deal. This matters to investors, but what matters more is this. I actually think Boeing could be as high as 420 in the next 12 months if the following conditions happen. Not just growth rates, margins, tax rates, but more importantly, the scenario and the thinking behind it. Like, think of it as a scenario. What's the bull scenario? What could go right for Boeing? If everything goes right in the next 12 months, reasonably right, how high could this be? There's no trade war, right? That China keeps buying as fast as they're buying, other emerging markets buy, the production is very stable, they're just selling, making money, and nothing changes like that in the next 5 years. They're just best of times. Therefore, I think that's what could cause them to go 420. Or, you know what? I think the worst case scenario is actually 290. And I put in assumptions that get me close to 290. And what are those assumptions? Trade war. Suddenly, there's giant tariffs on Boeing planes. Or worse, China forces its airlines to buy from Airbus. Switch your orders, okay? Because we're fighting with the U.S. for the next couple of years, and this isn't going to tamp down anytime soon, right? And with higher interest rates, people get worried about things. So orders get pushed out a few years, or orders get canceled, right? So that could actually start to happen. That could really start to hurt Boeing in the short term. I know they got a backlog, so not going to go away, but my scenario gets me to a range of 290. What's important to the investor is, what am I really saying? There's a lot more downside risk than upside risk in Boeing by communicating the bull and the bear. Think about Amazon. If I'm buying Amazon, and if you've been watching Amazon, it's starting to fall right now, that Amazon plus 10, Amazon down 20. That's the problem, is that Amazon's probably not going to double again in the next 12 months. Okay, so there's probably more downside risk to Amazon than upside risk. That's what the investor needs to know. I might still be bullish in Amazon. I think it's going to go up, but I still need to be realistic to say there's a lot of things that could go wrong that can be very bad for Amazon. Same thing if I'm doing Apple or whatever. So increasingly, what institutions want is they don't just want a target, they want a range, because they want to start thinking about their upside downside risk and the potential volatility of a stock. So I want you to communicate that by giving me the bull, the bear, and the target. So basically the bull and the bear is the peak and the trough, and the target is where in that range do you think it's going to be. That's really the way that you're representing this. And then as you go from 4 models, 4 different Excel files, why'd you change the assumptions for the bull? What assumptions did you use? What scenario had to come true to be a bull? And remember, this is 12-month look. So you're not talking about Boeing suddenly growing 20% a year or shrinking 20% a year. So It's got to be realistic to the bull and the bear, but nonetheless, you'll set up a target range. That's your assignment. Okay. So 4 files, fixed as is. Copy that. Target, bull, bear. 500-word write-up explaining your minimum, explaining your assumptions across the 4 models. Group project, turn in by 10 a.m. next Wednesday. That's group case 2.5. Right? Now, last thing I'll mention is when I did a version of this assignment last semester, 60% of the students got a 0 on this assignment. Okay? So I'm going to give you information that I felt bad, that I kind of set them up, and I was hoping that they would actually figure out the setup, but they didn't. And a lot of them hurt their grade and they were pissed off. So I'm going to give you information. So hopefully it doesn't happen to you, but it will still probably happen to many of your teams. So this is basically the assignment. Because I think it's instructive. All right, and here's what I mean by setting them up. People are like, what the hell is he talking about? So I gave a similar assignment and I said, do a bull and a bear and explain it. And what most people said is, take Boeing as a metaphor. Boeing, here's my target stock price, 380, plus or minus 20%. That's my bull's 20, higher, 20 lower. All right? So that was their answer. Boeing plus or minus 20, the bull was 20% higher, the bear was 20% lower. And they got 0. And they got pissed off because they wrote lots of words. And remember, your view is if I like lots of words, I should get partial credit. And I'm telling you that's not the way the class works. You can write lots of words and get a 0 in this class. Right? You can also get the right answer with no words and get a 0 in this class. So you need to have lots of words and a right answer. Why is plus or minus 20 not a right answer? What do you think? Yeah.
2 guesses. So first guess is that they didn't supply reason for the
Exactly.
20.
Exactly. It was arbitrary. Why plus 20? Why not plus 25? Why not plus 30? It was just an arbitrary range. And so that was actually part of the problem, is that there was no rationale for why it was higher or why it was lower. And that's exactly right. And so it's not a guess, it's what I want you to do. Because if I just told an investor, company plus or minus 20, they're going to be like, why plus or minus 20? If you just said, well, that's just a range I think it could be in, they're going to fire you. They're going to get to somebody else because there's no value to that range. So that's the first guess. What was the second one?
The second guess would be, you said that bull and bear tells you if there's no upside or downside risk.
Mm-hmm.
But just doing plus or minus 20, you're saying the risks are about equal?
Absolutely. And they may not be. And so exactly right. So what was very obvious to you wasn't obvious to 60% of my students last semester, and I had 170 students then, and I felt bad, but I thought it was actually a very important learning point. So I was very tough with the TAs and the grading for this because I wanted them to understand the 2 points that you just made. So I'm telling you this because it's not like I want you to do badly. I want you to do well in the assignment, but that's the point. That's what makes this class helpful. It's the art of valuation, right? So as I said, anybody can technically do the math. You can solve a pretty sophisticated algebraic equation. I don't doubt anyone in this room can't do it because you've been doing it, right? But do you understand why you're doing what you're doing? Do you understand what assumptions you're using and why things are happening? That differentiates the next level analyst. That's what I'm going to keep pushing you to do because that's more valuable in the real world, right? So long story short, those are 2 answers. By the way, here's the third one. Some people would just say, I'm a technical trader. I looked at historical volatility, and based on historical volatility, this is what it should be. Great. 5 years out, do you think that's really the case? I don't, because what you're assuming is the past repeats itself, right? And if the conditions in the past repeat itself, sure, you're right. But the further and further you go out, and this is why we do 5 forces, past doesn't always repeat itself. So yeah, if you're doing option pricing and you're doing 60-day option pricing, fine. But if you're doing 5-year cash flow valuations or longer with perpetuities, no, I don't accept that as the reason that it's going to be in this range. Could you use that as additional supporting evidence for other information? Sure, but that can't be your entire argument, that this is the historical volatility and so therefore this is the range going forward. That's not enough, not in this class. Okay? You got a technical class? Great, answer in the technical class. But we're going beyond the technical in this class. This is much more qualitative. All right. Questions, comments, concerns, crippling fears? All right, so I'll see everybody, just to wrap up one more time, next Wednesday. So Monday, I'm giving you class time, no lecture, to work on what's now group case 2, 2.5 with Boeing, extend, fix the model, right? And by the way, fix it in your actual model export so that if this comes up again with another company, it stays fixed, right? Fix the model in the as-is. By the way, if you want to update your as-is, feel free. Okay, you don't have to, if for some reason based on today's lecture, you're like, oh, maybe I'd like to change my as is, or because obviously the share price changing, feel free to change your as is, and then submit 4 files. As is, target, bull, bear. Explain those 5 assumptions, why you're making them as they're changing across the 4. We'll talk about this next Wednesday. Okay, see everybody in 1 week.